Let's dive in. Let's ask our very first question, and that really is, what is rapid growth? As we start thinking about it, it's a term that has a fair amount of confusion, and it's an area that everybody's interested in. If I were to simplistically define rapid growth, you could argue that it's growing faster than you did yesterday, correct? So if I grew 12% year on year as my average, and I do 13%, that is more rapid than the 12% is. You could argue in that particular spectrum. However, there's a few other factors that we need to take into consideration. In essence, we could argue that's rapid growth, but as we're sitting in the room today, that's not the type of rapid growth we're looking at, and there's other factors we need to take into consideration. The three factors we need to be looking at when we're coming up with our understanding of rapid growth are, A, our previous performance, correct? It's competing against what I did yesterday, I'm looking at that. B, I'm looking at general market growth. So for example, if I grew at 5% last year and the market grew at 5% last year, am I rapidly growing? I'm not. I'm growing at market rate, correct? Now this is where it gets very interesting, because in the emerging markets, there's a lot of companies that are articulating they're rapid growth companies, but what they're really doing is they're growing on the back of rapid growth in their market. So if you were in the infrastructure industry over the last 15 years, any area of this, and you were working in Dubai coming up to 2008, you grew very rapidly. Did you grow rapidly, or did Dubai grow rapidly? And did you benefit from sitting on the back end of that? So one is looking at the market growth rate. What we found out and what we all know, which I'm not surprising anybody in the room, is when the market rate drops, we get the true mirror and the true picture of what's going on. And we see whether a company truly had growth fundamentals in place. And then the third area for comparison is looking at the sector side of this. So how is the sector growing? So we're looking at how's our company, how's the market, how's our sector. Let's take Ralph Lauren Corporation as an example here. Ralph Lauren Corporation in 2005, their stock was trading at $24 a share in the summer of 2005. They were doing okay. They were well recognized. They were doing okay. They made some substantive shifts, though, and they changed their strategy, and they started moving from thinking like a regular retailer, moving into putting in place what we're going to look at, some of the rapid growth fundamentals. And they started making some very deliberate shifts and changes we'll go through. Summer of 2008, they were trading at $74 a share. So they were beginning to be recognized at this particular time as doing quite well. Attention was coming to them. Wall Street liked them. They were actually being called a darling of Wall Street in the retail sector. There was a lot of attention going on. We all know fall of 2008 was the financial crisis. Ralph Lauren took a dip for 2 quarters. Everybody took a dip for 2 quarters. Their stock value closed yesterday. Remember, they were $74 a share, summer of 2008. Yesterday, they closed at $176 a share.